Welcome to another episode of Millennial Investing Explained. Here's today's question. So after all of this discussion about various different instruments you can purchase, different strategies you can implement, the next thing you have to do is you actually have to buy that asset. You have to buy that financial instrument. You have to buy the stock or ETF or bond or commodity or whatever it may be. You have to actually place the order. And I know that this might seem simple, and some of you might be thinking, why is he even talking about this? But just the other day, I was reading the second edition of Ramit Sethi's book, I Will Teach You to Be Rich. And he had a story in there that just blew my mind. And so I knew I had to talk about it here on the podcast for you guys. Even if it's simple, I just want to make sure that everybody knows this so that nobody else makes this mistake. If I can save even one person from making this mistake, then this conversation is well worth it. So what you have to do is you have to actually purchase that asset. What happened in the story is there was a woman who invested in her account for about a decade or maybe even longer. She was continually putting money in the account every week or every month, just like she should, like everybody told her to do. But as she got to retirement, she didn't have much more money than what she put into the account. And she was shocked to see that because hadn't her investments been growing over the last decade or 2 decades? What she realized when she went to retirement is that she never actually bought anything in her investment account. And so her money just sat in her brokerage account in cash. And so it wasn't really earning any interest. It wasn't really growing. Even though she did all of the right things, she just made one small mistake and she didn't actually purchase anything. And so all of that time that she invested or thought she was investing, she wasn't actually getting the benefit of time. And so she missed out on all of that time that she could have used. And so I just want to make sure that everyone listening to the show today is aware that even though you're putting money into the account, just because you put the money in the account, it's not like a savings account. It doesn't automatically start being invested or anything like that. You have to actually pick the investments that you want to put it in. So that is very important. And just going forward, make sure that you're doing that for the next few decades before you hit retirement. And because that's so important, I want to talk about how to actually place the trade. Now, every platform is going to be different. When we talked about the different brokerages you can invest in, depending on which one you chose, it's going to be different on how you do this. So it's going to vary a bit, but in general, it's pretty similar. I've put together 2 guides on how to actually place trades on Robinhood and Fidelity. I put those in the show notes, so be sure to check those out so you can see how to actually place the trade. Like I said, your platform's probably going to be different, but it should be very similar and you should be able to find similar wording on your platform. So you should be able to follow it. But basically what you want to do is you want to look for somewhere on your brokerage platform that says trade and then click on that. And then it should bring you to another screen or another box that pops up and you'll need to enter the ticker symbol for the security that you want to purchase, whether you're buying or selling, and then how many shares for that transaction, and then the order type. The 2 most common order types are market order and limit order. A market order will purchase your security at the next available price, whatever that may be. A limit order does exactly what the name implies. It limits the price you're willing to pay or sell your security for. So if you've set a limit at $5 and the stock is trading at $5.10, it's not going to buy the stock until the stock falls below $5. Now, both of these transaction types have merit in different situations and in different strategies. But I would argue that for most newer investors who are not looking to time the market and, a few cents here and there, or even a few dollars isn't a huge difference over the long term, over 30 or 40 years, a simple market order should suffice. I know this information might be difficult to visualize or remember if you're driving or running or working out or doing yard work. So again, refer back to the guides that I've created and put in the show notes with step-by-step instructions and photos showing exactly what you need to do. And like I said, Fidelity and Robinhood's platforms aren't going to be the same as every other platform, but they should be similar and they should give you some idea as to what you're looking for in your specific platform. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.